The Silicon Valley Bank failed. The contagion started to spread to other banks, the bond market, and beyond. And we're just at the beginning. The government stepped in with a bold plan. Janet Yellen said, "The banking system is sound." But wait, isn't she the one who said inflation is transitory? By the way, what is transitory? Did she mean temporary? Anyway, the real question on everybody's mind is, what does this mean for land? That, good friends, is what we're discussing today on the Land.MBA podcast.
If there's one thing I've learned in my business career, it's that I don't have all the answers. Look, I'm an ambitious guy, and I like to make progress fast. The secret to achieving success fast is to harness the brain power of other people in the community. That's what the Land.MBA Smart Bar is all about. As veteran investor Jesse Marchand said, "The Smart Bar gave me the motivation and knowledge I needed to push through the tough times and accelerate my path to success." Seven-figure investor Mitch Milan likes to say, "There's one meeting each week that I never miss. It's the Land.MBA Smart Bar. It's like happy hour with my land investing buddies. I always learn something." So if you want to network with like-minded people, make new friends, learn heaps, get questions answered, answer questions for others, learn new strategies, get accountability, and overall get inspired while having a great time, check out the Land.MBA Smart Bar. For a short time, podcast listeners can get 20% off the annual plan, which comes to an insane $86 per month. Compare this to other programs which charge $250 a month or more. This is hands down the best deal you're going to find and the best way to invest in your success. So don't wait. Please go to land.mba/mastermind. That's land.mba/mastermind and use promo code podcast22 to join today.
Hello, all you gorgeous entrepreneurial land investors. This is Howard Zonder with my partner, the most amazing land investor, David Van Steenkist. We're so happy you could join us today. There is a lot going on in the world right now. It is a very interesting news cycle that's going on, and it really does have some big impacts for the land investor marketplace. We want to talk about that a little bit. Before I get there, please like, comment, subscribe. Particularly, we'd love it if you'd leave a comment on Apple Podcasts. It helps expand our reach and helps us a lot in the podcast ranking. So thank you for that. You have probably been hearing a lot in the news lately about the Silicon Valley Bank. Oh my goodness, isn't this exciting? It feels like 2008 all over again. The banking sector is starting to implode. I mean, let's just face it. That's kind of what's happening right now, and it's already starting to spread to the bond market and to the stock market. This is kind of scary stuff. I think yesterday the VIX index, which Wall Street considers to be their fear gauge, hit 12%. That's not good. And there was similar things happening in some of the metrics around the bond market as well. So this all started last week with Silicon Valley Bank, which is I think it's the 16th largest bank, or was this the 16th largest bank in the country? It's not that old of a bank, but it's big. And we want to unpack it. And it spread to Signature Bank. And Signature Bank is really interesting because on the board of directors of Signature Bank is Barney Frank of the Dodd-Frank Act, which was the banking act after the last debacle. So that's interesting. That's a conversation for a beer and another day.
2 beers, maybe.
But it's already spreading to other banks. Bank stocks have been tanking. It's the contagion is now spreading to Europe. Credit Suisse is in a lot of trouble, and a lot of other banks, their stocks have been taking a hit as well. President Biden stepped in and made an announcement. I think it was last week, or maybe over the weekend. I can't remember. And we're going to talk a little bit about that. But what we really want to talk about is what's going on and what this means for land investors. So if you want some clarity on this, listen on, because I think think hopefully we're going to be able to give you something that you can really, really use in your business. All right, let's see. So SVP was collapsing. The Biden administration stepped in and did what the government always does, which is make things worse. It seemed like it was actually going to make things better on Tuesday. Tuesday, things got a little bit more stable, a little quieter, but by Wednesday, it all gone to crap, and that's when things spread to the stock and bond markets. But let's unpack this a bit, what happened at SVP.
Yeah.
So since the late 80s, under Alan Greenspan, the Federal Reserve has had this loose money policy where they dropped interest rates practically to zero, which has created basically free money and the financialization of everything. And so in the last few years, you had this combination of very, very low interest rates, and you had the Biden administration injected about $5 trillion into the economy as a result of the pandemic. The combination of those two things just meant dollars everywhere, and dollars look for a home. People want to invest things. Whoever got that money, they wanted to invest it. And a lot of those people were investing in the tech sector. And so companies that really didn't even have a business model that would make any sense were getting investment. It sounded a little bit like the late 90s all over again. But they were getting all this money to set up these startups, and then they needed a bank for their company to manage, so they can manage their money and manage payroll and everything else. Comes around Silicon Valley Bank is the bank for the tech sector, as well as as big wineries in Northern California, if you're the governor of California. So so anyway, they basically were like a one-trick pony. I mean, they had one, more or less, they had most of their eggs in this one basket, which is the tech center basket. And David's been talking a long time about just how the tech sector has been shedding jobs. We've been talking about this since last November, December. The massive amount of jobs that have been shed in the tech sector. It's still happening. I mean, Facebook, I think, just announced another 10,000 that they're letting go. So it's kind of a bloodbath over there. But think about what that means. If the tech sector is shedding jobs, that means that their payroll goes down considerably, which means that they're not taking the money out of the bank to pay those people, which means the money stays in the bank, which means the bank is now sitting on a whole lot more cash than they used to be sitting on. And that's exactly what happened with Silicon Valley Bank. Their cash deposits practically doubled from 2021 to 2022. And they're a bank. They got to make money for their investors. And how do banks make money? They invest their depositors' money. That's what they do. But it's a bank, and they actually made what they probably thought was the safest investment you can make, which was U.S. Treasuries. And normally that would be true. However, because of inflation, the Fed started raising interest rates, and which meant new Treasury bonds that the government were selling were being sold at an even higher interest rate. So if you wanted to buy a bond, why would you buy an old bond at a low interest rate when you can buy a new bond at a high interest rate? So what that meant is that the market to sell the older bonds pretty much collapsed. Now, that's not necessarily a problem for a lot of people. That's what we call an unrealized loss. It's not a problem if you hold that bond to maturity. You're still going to make the interest, whatever it is.
Yeah.
The problem is if you need to sell the bond because you need money today. And that was the problem that Silicon Valley Bank had because investors recognized that, and depositors recognized also that they needed the cash. And so they got spooked about the safety of the bank. So they started pulling their money out. Well, now if they pull the money out, Silicon Valley Bank has to come up with the cash. It's sort of like that scene in It's a Wonderful Life when everybody comes to the bank and says, I'll take my money now, please. And so they needed cash. So they had to liquidate the bonds, but because the new bonds were more valuable than the old bonds, they had to sell the old bonds at a huge discount. Actually, they had to sell them at a loss. And they ended up losing about $21 billion on that tranche of bond sales, which did not do well for the investors. So the investors are freaked out, and so they're selling the stock, and the stock price is plummeting, and that's really what happened. And then that contagion quickly spread over to Signature Bank, which was focused not so much necessarily on tech per se, but more on the crypto markets. But then it started spreading to all regional banks because people are saying, well, wait a minute, if my bank is heavily invested in treasuries, then the same problem can happen with them. And so regional stocks started to tank, and now it's gone to Europe, and Credit Suisse is in a lot of trouble, and a lot of banks, even Deutsche Bank dropped 7%. A lot of banks are dropping right now. And then Moody's came out and they just downgraded the entire sector to negative. They went from stable to negative for the whole banking sector. So in this environment, Biden gets up there and he makes his announcement of how he's gonna shore up the markets and give everybody confidence. So what he said first is that, there's not going to be a bailout. Okay. But what they're going to do is they're going to make sure that all the depositors are whole. Well, the depositors...
It's a bailout.
It's a bailout. The depositors have $250,000 of FDIC insurance. Now, that doesn't mean that every individual account is insured to $250,000. It means for each owner or each at the bank, the entirety of all of their accounts is insured up to $250,000. So if you've got 3 different accounts, let's say you got a checking account and 2 savings accounts, and each one has $250,000 in it, that doesn't mean you're insured to $750,000. You're still only insured to $250,000. In order to get all of it, you'd have to move it into 3 different banks, $250,000 each.
Yes.
So what he's coming in and he's saying is like, no, we're gonna make depositors whole. That means we're going to insure the entire $750,000. Well, that's really good if you're Gavin Newsom and you own a couple of wineries with that bank at SVB, which is true. So in fact, I heard that only 10% of accounts at SVP were $250,000 or less. Every single one of them was above that. In a business accounts, you'd expect it to be more than that.
Many times above that, yeah.
So where's that extra money coming from? I think it's probably coming from taxpayers. But wait a minute, he said no taxpayer money. Well, Biden would lie? I can't believe that would happen.
By now, it's coming from our great-grandchildren. Maybe our
great-grandchildren.
Yeah,
for sure. So, there clearly is a bit of a bailout, but there's also this other problem is that around 2012, the rules were changed. I think it was at the FDIC, and they said in the next crisis, we're not doing bailouts, we're doing bail-ins. This is something we all need to pay attention to, because a bailout means the government's going to come and bail out the bank. They're going to provide the liquidity for the cash so people to maintain confidence in the system. Well, neither the Fed balance sheet nor the government can really afford to do that anymore. So now they're going to go to a bail-in, which basically means that your money belongs to the bank, and they're going to use your money as their liquidity, and that's scary stuff. Because then they'll say, you can have $100 a day. That's as much as you can take out.
Yeah, that scares the shit out of me. The bank, because they're trying to prevent bank runs, but then who knows? I think next week you could have bank runs.
Yeah, exactly.
I don't want to go down that rabbit trail, but I've got way too much in my regular bank right now.
Yeah, I think it's time to have more banks and spread it out a little bit. But the interesting thing about what Biden said is he's not really bailing out the investors. That's what's important here. So one way that a bank can raise money for liquidity is they can go to the public markets and they can sell stock and they can get more investors and they can raise money that way. But the problem is that Moody's just downgraded the entire sector to negative, and there's really no backstop for the investors. And they're looking at the situation saying these banks could be in a lot of trouble. And just because of the news cycle, banks are going to be going down, some worse than others. So investors are pulling out, which is why all these bank stocks are starting to tank. Now, if you're an investor of a bank, you don't really want to be invested in the bank right now because the bank sector sucks. And now what was a safe investment has become a risky investment. But you can't take that money and put it into bonds, because if the Fed keeps raising rates, your bonds are always going to be competing with next week's bonds, which are going to have a higher interest rates, which means the only way you can sell it is at a discount and potentially lose money. So then you say, oh, well, I could leave it in cash, but with 7, 8, 9% inflation, the money's just losing money every day. What is an investor to do? So that is where alternative investments start to look attractive. Things like gold, silver, bonds, fine art, things like that. Land. Did I mention land? Land. So land.
Did you say dirt?
Yeah, dirt. Dirt. There's money in them, our dirt. So maybe this is an opportunity. Now, obviously, we're not going to be selling land to BlackRock or Vanguard or big companies like that. But a lot of where the real bloodshed is taking right now is in the regional banks. And because the regional banks never get the support that they get from that the big banks get from the government. So and regional bank investors, some are large and some are small, but they're regional as well. So they know the regional area, and especially the small ones, they still need a place to park their money. Now, land is good and bad for them. It's bad because it's not liquid like a stock market is. I can't just take my land and go into the marketplace and have a whole bunch of people who would want to buy it in the next 10 seconds. But it is a good store of value, and that's really what they need right now. They need a store of value, because if they keep it in cash, it's just losing money every day. So let's just say they want to sit it out for a year and see what's going to happen. A piece of land could potentially really be a good store of value. They have to have some confidence that they're going to be able to sell it at some point when they want to. That's the key, which means that as a market, we just have to have the right land.
At a return, sell it at a profit.
And I'm not sure that's true. I mean, they just need to sell it not at a loss.
Correct. Not at a loss, and hopefully beating inflation.
Hopefully.
Yeah.
Or, like I said, store of value. I don't think it's so much. If they could find investments that are wealth appreciation, I'm sure they would be happy to do that. But I think wealth preservation is the moniker of the day right now. And as long as they can maintain their wealth and not have it be destroyed by inflation while they wait this out, I think that could be interesting. And then if they could find land that they could do something with, whether it's develop it or maybe sell it later as a profit, that's icing on the cake.
Right. Yeah, exactly. Or buy it, split it, sell some of it on seller financing. There's a lot of good opportunities. So
David, I got a question for you. So the banking sector's sucking wind right now. The tech sector is shedding jobs, and yet when you look at the economy as a whole, they're telling us that it's still hot, and we have to suppress it with high interest rates because that's what's driving the inflation. I thought about this. A lot of people say, "Oh, we have inflation because people are spending so much money." I don't think that's necessarily. That is one factor. From what I've heard, they flooded the market with so much money during the pandemic. So that's one cause. There's a lot more money chasing, the same amount of goods. Second problem is that people couldn't spend a lot during the pandemic because they couldn't get out. So there was all this pent up desire to buy stuff. So as soon as the pandemic started to come down, people went on this buying frenzy. And we went from a period of the highest savings rate that the country ever had to now we're actually going beyond that to the highest. People are not only spending the savings, but they're spending on the credit cards. And now we've got the highest personal debt we've had in history
ever.
So there is, and then you've got the problem is that the pandemic, because they shut down all the countries, screwed up all the supply chains. So we end up with this too much money chasing too few goods and too much demand chasing too little supply. And it's the combination of all of that that's driving the inflation, and then the artificial increase from Biden's war on fossil fuels, because increased energy cost is attacking every level of the value chain in the building of a product.
You're exactly right. I mean, that basically threw gasoline on the fire.
Good pun, right?
The fire's been brewing, like you said, ever since Alan Greenspan, what, 90s, late 90s.
80s during Reagan.
Yeah, it's really been brewing since then.
Yeah.
And so, you can't even really, to go political, you can't even, not that I'm a freaking Biden fan at all, but you can't put all the blame on him. Certainly credit is due where credit is due, but it's been brewing for a long damn time. And now it's coming to a head, and we're having to deal with it. So really what I think we've got going on, or at least coming, is stagflation. Because well, we've got it. If you look what has happened to the stock market in particular, and then what's starting to happen in housing, and what's happening in even commercial real estate, every place where leverage is highly involved, you're going to have price deflation. I don't care what the inventory is, because if the banks aren't lending, nobody's selling commercial assets and nobody's selling homes. And if the affordability on top of that, you've, even before these bank failures, you've got creditors drying up like crazy. Their lending practices getting tighter. But even prior to the run up of the interest rates, affordability was reaching a point where something had to give. Now you start adding these other macro factors: interest rates, energy, other costs involved in living, in running a business. People are just saying, hey, wait a minute here. And so, yeah, you've got stagflation. We're already, we're starting to see housing prices decline, inventory rising, all over the country. Certainly now we get into the micro, and we know that real estate is primarily local, but it cannot escape all the macro effects. Every market is impacted. It's just a matter of the timing and how deep.
Mm-hmm. Well, I think the point you just made is really important, which is that while a rising tide lifts all ships, and a lowering tide lowers all ships, just because a country is in a state of either growth or shrinking, it's not equally spread across the country. There are going to be areas where it's going to be deeper, and there's going to be areas that are having the exact opposite effect. We see that right now. If you look at the housing market of Denver and Phoenix versus other markets, say in North Carolina and some other places, or Connecticut or someplace like that, housing prices have not dipped even one iota, because the demand still is outstripping the supply. So, I think that from on a land perspective, it's the same thing. We've got to be really, really good with market selection right now, because there are going to continue to be markets that are going to be hot. They're going to, no matter what happens at a macro level.
Absolutely. So let's get into that a little bit, because this is a land podcast. So we've talked a lot about the current events of the banking sector, what's going on, and how that might impact our lives. And then I'm sorry I had to interrupt. I just got a text message from my daughter. It's my birthday today, and she sent me a message that says, "You're old."
I was going to say, I think I saw a couple extra wrinkles up on the top of the head there.
I'm scowling, yeah. Anyway,
happy birthday, buddy.
Nobody gives a shit about me. Let's move on. Thank you. Yeah. So how do we then invest in land? How do we keep our land flipping businesses successful in 2023? So
how do we turn the reality we just described into an opportunity for us as land investors?
Absolutely. And real estate investors as a whole, right? You've always, you've heard the term, great fortunes are made during economic downturns. And that's the truth. Historically, if you have the mindset and the skill set, mindset's first. If you don't have the skill set, talk to us. We'll help you on the skill set. But look, specifically for the land that we're buying, over the last few years, we've had what you've termed irrational exuberance. You can throw a bunch of spaghetti on the wall, see what's stuck. As long as you bought it at a good price, you could get it out there and flip it and sell it and at least double your money, triple your money all the time, even with desert squares and dime a dozen properties. If you bought it right and marketed it well. Well, that's changing. So now we've got to have the best property at the best price, a very good property at a good price that has great attributes. And we've got to have our market and our buyers in mind when we buy that property. So, quality properties, land where you can define the market, hunting land for hunters, fishing land for fishermen, recreational like cabin lots, things like that in areas where, you've got activity, you've got demand, homesteading land for homesteaders, prepping land for preppers. The important thing is that we can define a market and we can define our buyer avatar. So we got to do a little bit more homework up front. And what comes into that all now that's the land part. The land, has to have, good attributes like access, like utility availability, trees, views, water. The nicer it can be, the better. But now
the right attributes for the market.
Exactly. So where I'm going with that is now I think we also need to be a little bit more stringent in our market selection.
Right.
So we want to talk about job growth, or at least places where you've got good job stability and you've got ingress as far as people moving in. You've got inbound migration and good stable job growth. And I don't want to get into specifics on the types of industries and things like that. So Howard, talk to us a little bit about, you also have to do really, really good due diligence. What are some of the examples that we need to make sure that we are checking for in our due diligence?
Absolutely. As given what's going on, it is conceivable that this drives us into a economic slowdown, because what this ultimately creates is a lack of capital availability. It's harder for businesses to get money. Businesses are going to be more reticent to growing because they're worried that the market won't be there when they go to sell their products. So it just starts to slow things down. And then when that happens, if we do hit a slowdown, what that means is it's going to be easier to buy properties and harder to sell them. Now, we've defined a potential market for that, which is this investor market, which I think is really, really good. And then I would say that when we look at a property, we want to look at it, is it a nice to have or is it a must have? The more we can buy properties that are must have properties, the better off we're going to be. So if somebody buys recreation land, for example, that's a nice to have. Now, if your market is people that just have money to burn, that's fine. They'll continue to burn it. But homesteading land for a homesteader is a must have. Prepping land for a prepper is a must have. And a good store of value for an investor could be a must have. But what's going to happen is these people are going to be they're going to be looking even more carefully at the properties they buy. And so from a due diligence perspective, you have to done your work, and you've got to be able to position it as a really solid property. And that means that the chain of title work has been done, there are no liens on the property, that you really understand what the back taxes are, and hopefully you've cleared them out. That if it's a property that requires access, that access is there. Whatever, if it's a property that requires a driveway, that there is a place where, the grade is not so steep that you can't put a driveway in. They're going to be able to do those. These are all the kinds of things that we go through in due diligence. Now, some of these things we might be more careless about in good times, because in good times, a lot of times it's easier to sell than it is to buy. But if it's harder to sell, people are going to be looking at these properties with a finer, with their glasses on, and they're going to be looking at it much more seriously. So you've got to be ready to answer these questions.
Yeah. Can I interject for 1 second here? I would summarize that in buying properties where you can remove objections. If you've got, there's, like any access issues with your driveway. Oh, the lot over here is close to price. I don't need to put a culvert in over there. Yours, I got to put a culvert in. Things like that. And there are things that, if there's other really nice attributes to the property, are going to hopefully override that objection, especially if you can price it right.
Yep, absolutely. So I think we're got to start to bring this to a close. But I think what we can say is that the banking sector is creating a new market, I think, for us regionally, which is these small to mid-sized investors that can't be in the banks anymore and need a place to put their money. I think these are people who invest in banks tend to be people who want safe returns. So something like land, like I said, it may not be the most liquid investment, but it is a good store of value, and I think they may be a good market for us. If this drives us into any kind of an economic slowdown, it's going to be easier to buy properties than to sell properties. And so what we've got to do is we've got to make sure we're doing really good market selection. We're finding properties where we understand who the market for that property is going to be. And we know that there's, based upon that, we believe there will be a demand for it. We've got to do great due diligence, and we've got to pay the right price for it. When Dave and I started this business, the typical was 20 cents on the dollar to buy a property. In the last year or two, it's gone up to 30, 40, sometimes even 50 cents on the dollar. I think right now we've got to pay less because there's market risk on the other side. And so the most powerful tool in your toolbox is going to be the word no. When in doubt, the answer is no. Don't pay too much for a property. It's better to wait for the better deal, to make sure that you've got the ability to offer it a little below market and move that property, get the velocity money on the other side.
Yeah, but keep that.
The last thing.
Go ahead, and then I'll chime in. Yeah.
The last thing I want to leave you with is that if there's going to be an economic slowdown, or and it doesn't mean it's going to be slow. I mean, right now the economy's kind of going hot right now, but it just has to go over the crest and start going down when people's perceptions start to change. If that starts to happen, what companies, larger companies in particular, always want to get ahead of it. So what they do is they start clamping down on their spending because they don't think the revenue is going to be there, and they want to maintain their margins. And they do it across the board. And one of the things that they really suppress is their marketing spend. So the companies, when we said at the beginning that millionaires are made in economic downturns, the companies that do great are the companies that double down on their marketing in a downturn, because nobody else is talking, nobody else is getting the word out. If you're the one out there soliciting, if you're the ones whose letters are landing on people's desks, you're going to have the opportunity to buy the properties. And if you're doing the marketing on the sales side, you're the one who's going to have the opportunity to sell it. Yep. So not the time to slow down.
Exactly. Marketing. And there's several other points that we can discuss, but I think we'll roll those into another podcast because we're out of time here. But guys, keep at it, be consistent, and be persistent, and have an awesome day and week. And feel free to reach out to us if you've got any questions, need any help in your land investing journey. Adios. Peace out.
See ya.
We hope you enjoyed this episode, had a bit of fun, and walked away with some actionable insights that you can apply to your business. Dave and I have got some great content and interviews planned, so don't forget to rate, and review, and of course subscribe to this podcast on iTunes, Google Play, Stitcher, or wherever you get your podcasts. If we mention any interesting links or tools, you'll find them in the show notes. To learn more about Land.MBA, visit our website at, wait for it, Land.MBA. See you next time on the Land.MBA podcast.